The views, thoughts, and opinions expressed on this show belong solely to Let's Talk TCI Real Estate and not that of Keller Williams TCI or any of its affiliates. Any action you take upon the information provided on this show is strictly at your own risk, and Let's Talk TCI Real Estate guests or hosts will not be liable for any losses and damages in connection with the use of the material. I am not an investment advisor, broker, or dealer. Good afternoon, everyone. Welcome to another episode of Let's Talk TCI Real Estate. I am happy to be here with you today. As always, I like to start by asking you to please like the page, as well as share it with anyone who you know may be interested in listening to this conversation today. Today's conversation will be about insurance and real estate. Before we get started, I always want to I would like to thank my guest, Ms. Roselaire Forbes from the Turks and Caicos Real Estate Association, who was on the show last week, for joining us last week. And thank her for the information that she did impart with our viewing audience. I just want to make one clarification based on a comment I had from a viewer last week after the show. They were not sure as to if there was a fee for a real estate agent and a broker to pay to get into the Turks and Caicos Real Estate Association. I just want to make a clarity that yes, there is a fee as an agent, which is $500, and there's also a fee as a broker, which is a higher amount. But as always, if you are interested in becoming a part of the Turks and Caicos Real Estate Association, please refer to the Secretary of the Turks and Caicos Real Estate Association, and the office is just upstairs, the National Health Insurance Board office, and the secretary is Ms. Simone Rigby. You can make contact with her and she can give you further instructions on how to become a part of the association. Otherwise, please revisit the show and more instructions is listed on the show. So with that said, I just want to get right on to my guest for today. And I am delighted to have in my presence Mr. Anthony Lancaster. So could you please go ahead and introduce yourself?
Thank you, Vanika. I'm Jamaican by background, and I've lived here approximately 25 years. I've spent about 52 years in insurance. I went into insurance just after leaving school, and I spent the first 2 years of my career filing papers. So I'm very good at filing papers. I've carried out most of the functions associated with my industry. I've been an underwriter with an insurance company. I've settled claims. I've drafted policies. I've been an agent. I've been a broker. I've been in sales. I have started 3 companies from scratch. I've done many functions associated with insurance. I've bought and sold companies, and by qualification, I'm an associate of the Chartered Insurance Institute of London, and I'm also a chartered insurance practitioner. I'm vice president of the Insurance Association of the Turks and Caicos Islands. And in 2007, I founded the Insurance Center here, and I currently manage it.
You are quite well-rounded, which is really good. So you know your stuff.
I hope so, a little bit. I'm very good at filing.
Well, I'm pleased to have you on the show today, and I look forward to this conversation that we are about to have about real estate and insurance. And I just want to just say to anybody at this time, if you do have any questions, we're going to leave space for questions at the end of the show. So please start posting your questions so I wouldn't miss any of them while we go through the list of questions that we have for Mr. Lancaster today. Okay? So we're going to start off by asking you to explain the role that insurance plays in the purchasing of real estate in the Turks and Caicos Islands.
Well, quite frankly, without insurance, there would probably be no real estate market as we know it. I don't think those big condominiums and hotels on Grace Bay Beach would exist if underwriters weren't prepared to issue insurance policies to cover them in the event of damage. Let's face it, we live in a catastrophe area.
Correct.
And prone to hurricanes. And I can't see lenders, I can't see banks and other lending institutions putting their money into mortgages if their collateral wasn't protected by insurance.
Exactly. That's true. So then tell me then, how do you calculate the cost of insurance that is payable on properties, whether it's a big development or even just a regular residential home purchase?
That's a rather involved question, and I'll try to explain. In order to address this, we have to understand the distribution of insurance. All the companies in the Caribbean now are small insurance companies. They are restricted in the capacity that they can take on. So they purchase reinsurance from much larger markets. They purchase reinsurance from large reinsurance companies, primarily in Europe, companies that your viewers may never have heard of, like Munich Re. I mean, it's not a household name, but
right.
They actually insure a lot of the risk in these islands. Now, they effectively set the minimum price of insurance because the local insurance companies, who are, if you like, the retailers of this trade, and the reinsurance companies are the wholesalers, they're purchasing the product from the wholesalers at a price. And they add to that something for their profit and something to cover their own costs. And that then is the minimum that they will offer insurance for. Now, that's the first phase of that rating process. The second phase is deciding how much to add for actual underwriting features. And those underwriting features are, what's the construction of the building you're going to be covering? What's its use? Is it a garage? Is it a sales shop? Is it a home? So these premiums these rates are loaded for occupation and construction. As well as that, there are other features, and probably the most important one is what the claims record has been of that particular risk. How have they fared through hurricanes like Irma? After Irma, there was quite a lot of reshuffle of insurance premiums. First of all, the premiums went up as a result of increased reinsurance costs, but as well as that, underwriters looked carefully at each risk to see how they'd fared in Irma.
Right.
If there was a large claim attached to that particular risk, then it indicated to them that the construction might have flaws, and they either discarded that business or loaded it. So these are the features and there's one other feature that isn't always taken into account, and it's a feature that you would think would be taken into account, and that is how near is your structure to the water? How near is it to the sea? Well, in fact, you might be surprised to know that generally insurance companies charge the same rate for an oceanfront property as they would for a property sitting on a hilltop.
Right. So because you're talking about the same rate then, and I understand that there's different features that will help dictate the price, but is there like a like a standard percentage range then?
There is a standard percentage rate for what we consider a standard risk, which would be a concrete building with a relatively low claims experience, and the sort of standard home that you'd find. Yes, there is a rate that's generally accepted at this time, and realize that because these rates are all based on reinsurance and they're renegotiated annually, the rates go up and down. At the moment, you're talking about a rate of somewhere between $9 and maybe $11 per thousand of value, $1,000 of value.
Okay. And in talking about rate, I know that property insurance is different from like the content insurance. Is this the same process? Method as to how you come up with the cost for the content insurance?
It is really. Some insurance companies charge a little more for contents because they're more easily damaged and they're subject to theft. But generally, companies will charge the same rate.
Okay. And also you were talking about the differences because, if you're closer to the water, et cetera. Is there certain kind of building structures that insurance companies would not cover?
Okay, let me tell you a little story. Some years ago, there was a developer who, as part of the development plan, was going to build these little rooms on stilts, timber rooms on stilts over the water. Mm-hmm. I don't know if you've seen them, but they have them out in the Pacific Islands. They have them in Seychelles, and I believe they have them in Jamaica as well. I've seen them. I've seen them on TV, and they brought these darn things to me, and I was scratching my head, thinking, how am I going to insure these structures? Because in a hurricane, they would probably cease to exist.
Right.
All the insurance companies I spoke to about this, here and abroad, looked at me and shook their heads. Fortunately, or unfortunately, as it might happen, that development didn't happen. But that's an example of a risk that would be very, very difficult to place. We would have been able to place it on the basis of the rest of the development, which was substantial and which was of a much better construction and much better risk, and it would probably have dragged the poorer risk element along with it. You can expect to pay more for a wooden structure like a timber framed building. You can expect to pay more if the building has any substandard features that underwriters would feel cautious about accepting. Apart from that, generally, the construction here, our planning regulations here don't really permit substandard buildings. I mean, buildings that are built here have to undergo planning, and they have to be of a standard that will that will stay in place for hurricanes.
Correct. No, I know planning does have a particular standard, but sometimes I'm asking the question also because that some of the homes that were built, previously much earlier on, like you said, they're timber frame. Sometimes you do have persons who want to buy properties like that, and it's always good to know, if those properties can be insured, or if it just,
They
like you
can,
said,
they,
incurs a higher rate.
they can be insured, but they will incur a higher rate. Now, there's something I'd also like to interject here, and that is that if someone has a timber framed home, if that home is severely destroyed, then planning will insist on them rebuilding in concrete. They won't get planning permission to rebuild in timber. And so when they insure that timber frame structure, they have to insure it for the value of a rebuilding in concrete. And this needs to be brought to the attention of the insurance company, just so there's no confusion about it when the time comes to make it clear.
That's interesting for the rebuilding costs. Yeah. Okay. I always wondered how that worked. So, in any insurance policy, in terms of purchasing a property, what are some of the exclusions that may be in an insurance policy that you should look for that sometimes we overlook?
The dreaded fine print.
Exactly.
Okay. Well, I'll tell you some of the things you should look for. All insurance policies contain what are called unoccupancy warranties, and this is especially of significance now when there are a lot of unoccupied homes that were previously being rented on a regular basis. I'm talking about vacation short-let properties. These policies have these unoccupancy warranties where if a home has been unoccupied for a period of time, it may be 30 days, it may be 60 days, then certain perils are excluded. Those perils include theft, malicious damage, and most importantly, burst pipes. So you have to be sure that you're complying. If you have a rental property, you have to be sure that you're complying with these warranties. And the way to do it is to have them inspected perhaps once every 2 weeks. And by inspection, I don't mean a thorough inspection, but just a walkthrough to make sure that nothing is leaking and there's no one squatting there that shouldn't be there, that nobody is pilfering from the place. And
so that can be like a property manager can do that then?
A property manager can do that, certainly. But many rental properties don't have property managers. They lock the place up and they may ask a friend to drop in on occasion and take a look. Mm-hmm. Well, when a pipe bursts and water goes everywhere and the drywall and everything is full of water, then when the claim is made on an insurance company, they may decline it on the basis that the property was unoccupied for beyond the 30 or 60 days. And you need to get somebody to inspect it, and then you need to go to your insurance agent and you say, hey, listen, I'm having my property inspected every 2 weeks. Can you let the insurance company know so they waive the unoccupancy warranty? So when you have that burst pipe, when it occurs, then you can show that the property is being inspected and the exclusion will not apply. You'll be paid for your claim.
Okay. So go ahead.
That's very important. What else is there? Okay, well, funnily enough, the cover for storms vary between companies.
Mhm.
And I certainly know of companies that won't cover rain damage unless the building itself has been breached. That means that, in a hurricane, water comes in everywhere, doesn't it? And you don't know where it comes from, but it comes. And it can cause damage. It can cause damage to drywall and contents and carpets and all sorts of things. Well, there are companies that will only cover that damage if you can demonstrate that a window went or wall went and the wall to let in the water. So look at that one carefully. That's a real fine print clause. Another thing to look at is your what we call your interruption insurance. And that is your loss of income from, say, rent. Now, this is thrown in by most insurance companies. Some of them apply limits, and some of them don't cover it at all. Generally, it's for 10% of the value of your buildings. So, if you have a rental property, a short-term rental villa, and it is damaged, it's made uninhabitable, and you lose rent as a result, you can claim for that loss under most policies up to 10% of the value of your buildings. Now, some companies say 10% of the value of your buildings, but subject to a limit of X. And some companies don't cover it at all. Now, if you have a rental property, that's a very important benefit because you know your property can be uninhabitable for a long time.
And that's what I was going to ask, how long of a period of time before you can do a claim?
Yeah, well, I mean, you make your claim as soon as the damage occurs, and you estimate what your loss of rent has been because you have bookings that have been made, and the people can't come or they can't take up those bookings because the place is uninhabitable. So you have a pretty good idea of what you're going to lose, and I won't go into the fine details of how that's calculated, but be sure that you have that cover. If you have a rental company, if you have a rental villa, be sure that you have that cover and that you have the widest possible cover for that loss.
Okay. Well, that's important to know. Is there any other point, you want to make in terms of what's excluded, especially because, like you say, we're in a hurricane zone?
Yeah.
Climate, go ahead.
I would digress a little and say at this point that it's a good idea to look at the security of the insurance company you're using.
Mm-hmm.
Insurance companies are rated by a rating agency, an international rating agency called AM Best.
Okay.
There are several A-rated companies. Which is excellent. There are B-rated companies that is good, and there are some companies that have no rating at all. Now, I'm not saying that the companies that are unrated should be avoided at all costs, because they may be perfectly good companies with perfectly good security. But it's as well to bear this in mind if you're looking at a level playing field, because certainly you want your insurance company to be there and trading when you have a catastrophe here and multiple claims are being made on them.
So how do you, like you said, how do you find that information out? Well, to know what your insurance company rate?
Ask them if they're AM Best rated, and ask them what their rating is. They'll tell you. They have to. As a matter of fact, the ones that are AM Best rated especially the A-rated ones, are very proud of it because to have that rating, you really have to have A1 security, and so they tend to advertise that rating quite prominently.
Okay. Well, that, like you said, that's a good information to know. Ask about the rating of your insurance company. And like you say, if they are A-rated, they will be proud to announce that to you.
Oh, definitely, definitely.
Okay. A few questions. I have a number of questions. Again, if anyone is tuning in and have any questions, please put it in the comment section so that we can have it in a few when we're asking questions. So when securing a mortgage through a bank, right? I know that it is mandatory for you, especially if you're purchasing a home, a developed property, that you should have insurance. Most banks will have an insurance company that they allow you to use. Do you think it is better to use the bank recommended company or to outsource to another insurance company?
Well, the banks have good agencies, and generally the companies they use are strong and secure. Also, they will generally provide very good credit terms. I mean, I believe that they normally collect the premium over the period of 12 months, and it's by direct debit, so it's taken out little by little out of your account. And insurance is a big ticket item, so it's a lot of money to find at one time. Although most of the insurance companies have their own credit plans, and they'll offer you installments. So those are two things going for using the insurance company. Now, using the banks rather.
Right.
Now, for the insurance companies, I'll put it this way. Um, Insurance professionals are insurance professionals. That's what they do. That's where their training is. That's where their experience is. That's where their professionalism is. Banks are bankers. Generally, the people offering insurance are not insurance professionals. They are bankers who have been scripted and trained to a degree to offer that service.
Correct.
I would always tend to go to an insurance professional. I would tend to go towards the someone from the insurance industry itself who can guide you on the best cover for you and how to go about protecting yourself properly. The other consideration, though, is price. And you should certainly, if you have a home that you're going to insure, as I say, it's a big ticket number, and you should big number ticket rather, and you should seek quotes from a few insurance companies and ask the bank to quote as well. And that should come into your decision also.
Correct. Okay, and then also talking about banks and insurance. A lot of times we hear about insuring properties, and with the banks, the term life insurance also comes up. Can you explain this connection between life insurance and the purchase of real estate? Clarify in simple terms, how can you benefit also from life insurance, and what are the restrictions are there with it? It's a wide question, but trying to talk about life insurance.
And life insurance is a product I've never actually handled here, but I have some experience in life insurance in other areas, so I can use that as a platform to work from. The reason for having life insurance is quite simply that the lenders want to be sure that if the borrower passes, if they die, there is money available to repay the mortgage. Now, this has two benefits. One is it repays the mortgage, and the other is it means that their dependents have a home without having to worry about servicing a loan. because the dependent dies, the settlement is used to redeem the mortgage, and the home is then mortgage free. Of exclusions and fine print, there isn't a lot really. I mean, the way this risk is traditionally written is on what's called a decreasing term policy,
Okay.
where as the mortgage is paid off, the amount covered is equal to the outstanding, and it goes down and down and down and down until at the end of the mortgage period, if the borrower is still alive, then the policy ceases, and the policy ceases and the mortgage is paid off. The thing to remember about this is that it only protects your mortgage. There's nothing remaining out of that once if it's a decreasing loan mortgage anyway, right, then there's nothing left once the mortgage is paid off. And most people think of a life insurance policy as protecting themselves and their dependents for the extent of their life, however long that might be.
Right.
So the mortgage life insurance policy that you buy will be specifically for the mortgage.
Okay, and supposing, I mean, I'm just thinking, I'm sure that age would also play a role in being able to qualify for life insurance for a mortgage, right?
Age and state of health, yes, absolutely.
So, would there be a time, just say, suppose there's a time where somebody, for some medical reason, would they not be able to qualify for life insurance? How do you handle something like that?
I'm going to have to plead the fifth on that one. Because as I say, right, I understand the fundamentals of life insurance, but in terms of the actual underwriting, in terms of the actual underwriting processes and procedure and protocol for the various companies here that do offer life insurance, and I think there are only a couple that do. But in terms of how they go about rating and how they go about acceptance, I'm afraid it's something I don't know a lot about.
That's fair.
So I'll have to wimp out of that one.
No problem. So I have a question just from a real estate standpoint in terms of persons who choose to sell real estate on their own, who's not actually a licensed real estate agent. Usually as licensed real estate agents or brokerage firm, you're expected to have professional liability insurance. Is this something that those persons should also consider who choose not to use a licensed real estate brokerage or agent? Do you think this is something they should be looking at?
Let me put it this way. First of all, let me explain what professional indemnity, it's called different things. It's called professional indemnity, it's called professional liability, it's called errors and omissions insurance. Let me tell you what it actually covers. It covers claims made against the policyholder as a result of their errors and omissions. Mm-hmm. So if you're a broker, mm-hmm, and you're selling a property and you describe the floor area of the property as having 3,500 square feet and actually only has 3,000 square feet, you've been dilatory in terms of your measuring of the property and your description of it.
Correct.
Somebody buys that property in good faith, and they discover the error and they seek to abort the purchase. and that affects you, and it affects the owner as well. And you are sued for error, for that error or omission.
Omission, you're right.
Right?
Mm-hmm.
And the purpose of this policy is to protect you against those claims. You, the broker, working for a company. Now, that insurance is expensive, and it's difficult to get. And in order to get it, it involves a thorough assessment of the firm applying for the insurance. In other words, they look at it, they look at its financial ability, they look at its experience, they look at whether they've ever had any similar claims made against it, what their loss experience is, and so on. It's a very detailed assessment. A long time ago, I tried to set up a scheme for the members of TCREA, a professional indemnity scheme that, because we were going to insure everybody would have their own policy, but because we were going to insure everybody, then we hoped to have certain economies of scale, and each firm would pay a reasonable price for that insurance.
Right.
Never ever worked, because the moment a company took a look at the proposal form and saw all the sensitive and confidential questions being asked, they never wanted that information to leave their office. They certainly didn't want it to possibly go into a pot with other competitors. And at any rate, the plan was a dismal failure. Now, I've kind of gone around the bush without answering your question, but the answer to your question is that a policy like that would not be available to individual sellers.
Okay. I just wanted to know that. Okay, thanks so much. Can I just ask you, are there any tips that you can share about cutting costs when purchasing insurance?
There are very few options, to be honest with you, to reduce the cost of property insurance. The most immediate one is to choose a higher storm deductible, because a lot of your cost goes into insuring hurricanes. And generally, the default deductible under that policy is 2% of the value of the insured value of the property. Mm-hmm. Now, you can negotiate discounts for taking 5% or 10%. Generally, these discounts are weighted in favor of the insurance company, because with a 2%, with a 5% storm discount, right, you get a 15% discount. With a 10% storm discount, you get up to 20 or 25% discount. Okay. So you can reduce the cost, but you're increasing your own exposure quite substantially. One thing you should never do is reduce the value, the insured value of your building below its estimated rebuild value, because it is severely penalized.
Okay. All right.
Let me just think a second. For commercial risks, for thefts, you can choose a lower limit for covering theft. It's called a first loss limit, and that will give you a quite a substantial reduction on your theft insurance. For example, if you have a shop and you have $200,000 of contents, and you say, okay, I'll only cover theft for $10,000. So if a break-in occurs, $10,000 is the maximum an insurance company will pay, not $200,000. They'll give you quite a substantial discount for that.
Okay.
I can't think of any other way, to be honest with you, where you can go about reducing the cost of your property insurance. The hurricane discount is about the only way for homes.
Okay. Insurance is very important for any property, but I had to ask the question because sometimes money does become a factor in terms of purchasing insurance. So you always want to know from the professional. I'm not trying to cheat the customer of getting the value for what they need, but just to make sure if there's anything they can do, to alleviate those costs. So I've just been monitoring the feeds. I haven't noticed any questions that have been coming in. And we are almost at our 45-minute limit. I'm just going to ask you one more question, and then I'm going to give you an opportunity to share some remarks. I want to ask you, for someone who does not have a mortgage obligation and they may have a strong savings, right? Why should this individual continue paying property insurance? I'm asking this because I'm being honest. This is the Turks and Caicos Islands. We have a lot of people who be like, I don't need to pay for insurance. So please tell them why it's still necessary.
Okay, I get asked these questions quite a lot, that particular question quite a lot, particularly from people who have gone to great pains to protect their buildings. I mean, they have some of them have solid concrete roofs and shutters and all sorts of things. And they say, well, I don't think that my building can be destroyed, so I'm just not going to insure. And my answer to that is, first of all, the hurricanes are seeded with tornadoes, and a tornado will tear down any structure. Even if it's a pillbox, it can destroy it. I've seen the results of that over in North Caicos. Mm-hmm. Your home is your most important investment. It would be very difficult for you to save sufficient to make it worthwhile not insuring. It would be very difficult for you to save sufficient to replace that home if it was to be completely demolished by a fire or a hurricane.
Right.
And that's my answer. So because you don't owe any money on it, that's not a reason for not insuring.
Right. And even if you have a strong savings, that's the other point, is because some people say instead of investing that money, yearly, I put it on a savings. And then in the event, if something happens, it's there, but otherwise I can still have access to it. So some people think along that line as well.
Think of it this way. You have a $250,000 house, right? And you have a nice savings account that's building up. One assumes you're saving for retirement, you're saving for some other reason than simply to rebuild your house if it blows down. Mm-hmm. Mm-hmm. When that house blows down, that $250,000 is gone. It's just gone like that. I mean, you have to rebuild, and it happened. It's happened to clients of mine in Irma. I mean, I have friends who weren't insured, and they had severe losses, and they certainly wish they had insured.
Yeah. Well, I know one or two persons I actually spoke to about getting insurance on their properties, and they were of the same opinion. Like, hey, we are always threatened with hurricanes, but they never come here. And during that same time, actually, their house did get damaged, and they were so grateful that they did actually get the insurance. because the hurricane did come when they least expected it. So
Good.
we just never know.
And we don't. And that's insurance. Insurance is a gamble. Insurance is a gamble. It's been expressed this way to me. Insurance is exchanging the certainty of paying a premium for the uncertainty of a catastrophe.
That's a good way to put it. Okay. So as we have come to the end of this show, I would ask you to share with the audience any information that you think is relevant to insurance and real estate that we did not speak about, and any helpful tips or myth that you would like to clarify at this time.
Certainly. I think it's of prime importance that you feel comfortable with your insurance consultant. You should feel comfortable enough to ask any question, and they should be able to answer you. They may not be able to answer you immediately. They may need to carry out their investigation, but you need to be comfortable that they're giving you correct advice. That perhaps is the most important consideration with buying insurance. The other thing of prime importance is that you do insure for the correct value. Many claims are penalized because people underinsure. They don't insure for the correct value. They save a little money, but a storm or a fire comes along and their claim is drastically reduced. It's a clause called an average clause that makes this happen, and I won't go into it, but it's very, very severe. Remember as well that when you insure, you don't insure for the market value of your property. Land is uninsurable. You insure for the rebuilding cost of your buildings or the replacement as new cost of your contents. And finally, as I said earlier on, look at the security of the company that you're going to insure with. Make sure that they are secure and that they are capable of withstanding a severe hit here. Those are the things to look for in insurance, and depend on your consultant. Go to your consultant, take the time to set things up properly from the start, and maintain a close association, because you should be looking at this every time. They're annual policies, and you should review them every time they come up for renewal.
Well, thank you so much. Can I ask you to please give your information for anybody who may want to contact you about insurance?
Certainly. They can get hold of me. My telephone number is 232-4611, or they can email me at, and this is a mouthful, I'm afraid, it's Tony.Lancaster@Insurance Center TCI, that's spelled INSURANCECENTRE TCI.com.
Well, thank you once again, Mr. Anthony Lancaster, for joining us today. And it was a pleasure to have you on the show. I also want to say thank you to all those who were listening in, who took the time to listen. For sure, if you do have any questions after today's show, please feel free to give Mr. Anthony Lancaster email. He can answer your insurance questions, or even if you want, drop your questions in the live feeds and we will get it over to him. So until next week, stay safe and remain blessed. Thank you so much for watching.
Thank you, Vanika.